Welcome back to the deep dive. Today we're embarking on, well, a really crucial exploration into the very foundation of corporate trustworthiness. Forget just looking at the final numbers. We're peeling back the layers to understand how companies build the financial health that, allows us to rely on them.
It's a fundamental aspect of financial integrity that often goes unseen, but it's vital to the reliability of our entire economic system. We're going to discover how auditors go beyond mere calculations to scrutinize the bedrock upon which those financial numbers are constructed.
Exactly. We're diving into the essential, yet often misunderstood world of integrated audits. It might sound like a technical term, maybe a bit dry even, but by the end of this deep dive, you'll have a crystal clear picture of what they are, why they matter profoundly, and how they contribute directly to the confidence we place in the companies we invest in and, well, interact with daily. We've got some truly insightful source material to unpack, so let's get started. Okay, let's unpack this core concept. Our sources tell us that under PCAOB standards, that's the Public Company Accounting Oversight Board, which oversees the audits of public companies, an integrated audit isn't just one audit. It's effectively two critical assessments rolled into a single, comprehensive process.
Right, and what's truly fascinating here is that it's about a dual perspective. Auditors are looking at both the financial statements themselves, the balance sheet, income statement, cash flow, all the traditional numbers, and they're simultaneously assessing management's evaluation of how effective their internal control over financial reporting, or ICFR, are.
ICFR.
Yeah. Think of it as auditing the final financial results, and the equally important how, the systems, the processes, the checks and balances, the entire organizational infrastructure that produces those results. This is why it's also commonly referred to as an audit of internal control over financial reporting. It's a powerful concept. It's not enough for the numbers to look right. The underlying machinery that generated those numbers must be robust and consistently reliable.
So it's a bit like a mechanic, not just checking if a car runs and measuring its speed, but also, looking under the hood to see if the engine parts are all working properly and efficiently together. You might have a car that starts and moves, but if the timing belt is frayed or the oil is low, there's a bigger fundamental problem lurking, waiting to cause a breakdown.
That's a perfect analogy, precisely. Because a company's internal control system is its engine for accurate financial reporting. If that engine has a fundamental flaw, maybe a design defect, a broken component, or even just inconsistent maintenance, then even if the car gets from point A to point B for a while, it's operating on borrowed time. An integrated audit ensures that the engine itself is robust, reliable, and free from critical design or operational flaws that could lead to significant financial misstatements or, worse, fraud. It's about proactive assurance rather than just reactive problem solving.
Okay, that makes sense. Now, our sources mentioned the Dodd-Frank Act, a major piece of legislation that reshaped the financial landscape after the 2008 crisis. It sounds like something straight out of a financial thriller. What did it change specifically about who has to get these integrated audits? Was it a blanket requirement for everyone before, or did it make things more targeted?
That's a great question, and it really connects to the bigger picture of regulatory evolution. The Dodd-Frank Act actually amended Section 404 of the Sarbanes-Oxley Act, or SOX, which originally introduced the integrated audit requirement. Before Dodd-Frank, many smaller public companies found the burden of ICFR audits incredibly heavy, citing, disproportionate compliance costs. So rather than a universal mandate, Dodd-Frank made the requirement more focused, a deliberate effort to balance robust regulatory oversight with the realities of business operations, especially for smaller entities.
Right, trying to find that balance. So this means it created different tiers of scrutiny, right? Who are these certain issuers that still need this deep dive?
Precisely. It means only certain issuers, essentially, publicly traded companies that issue securities are required to have an audit of their ICFR. Specifically, these are categorized as large accelerated filers and accelerated filers. The distinction is based on their market capitalization, which serves as a practical proxy for their size, public visibility, and the breadth of their investor base.
Okay, so size matters here. What defines a large accelerated filer?
A large accelerated filer, for instance, is defined by the U.S. Securities and Exchange Commission, the SEC, as an issuer with a worldwide market value of outstanding common equity held by non-affiliates of $700 million or more. Non-affiliates here are basically investors who aren't closely tied to the company's management or major shareholders. It's a clear measure of how big and widely publicly traded the company is, reflecting how widely its shares are held by the general investment public. These are the truly big players, often household names, whose financial health impacts a vast number of investors and the stability of the broader market. Their financial reports carry significant weight.
700 million or more.
Okay.
In the next tier down.
Then we have the accelerated filer category. This includes issuers with a worldwide market value of outstanding common equity held by non-affiliates of $75 million or more, but less than $700 million. So these are still significant public companies, well beyond small startups, but not quite in the mega corporation league. Both of these categories are deemed to have a substantial public interest that warrants this deep level of financial scrutiny.
Got it. 75 million up to 700 million.
Yeah.
But there are exclusions too,
Yeah.
smaller companies.
Yes, exactly. What's also important to note are the exclusions. Smaller reporting companies, which are defined as entities with annual revenues of less than $100 million, are specifically excluded from these definitions and thus from the ICFR audit requirement under Dodd-Frank. This decision raises an important question about balancing regulatory burden with investor protection. The prevailing idea was to reduce the compliance costs for these smaller public companies, acknowledging that the extensive requirements of an integrated audit might disproportionately impact their ability to operate and grow, while still ensuring robust oversight for larger entities where the public investment risk is greatest.
So bigger companies get more scrutiny, which, as you said, really makes sense for public trust, especially when their financial performance can sway entire markets. But what about companies that aren't issuers, like private companies or other non-public entities? Do they get a complete pass, or are there similar frameworks that still encourage or require robust internal controls for them?
Well, for non-issuers, typically private companies or other entities not publicly traded their internal control audits, when integrated with financial statements, are governed by a separate set of standards issued by the American Institute of Certified Public Accountants, or AICPA. These are known as SAS 130. While there are some specific differences in application, our sources highlight that the underlying principles and objectives are very similar. The fundamental goal of assessing internal controls to ensure reliable financial reporting remains the same, regardless of whether a company is public or private.
So the core idea is the same, even if the rules differ slightly.
Exactly. It speaks to a universal need for financial integrity, even if the specific regulatory drivers or reporting requirements differ. Strong controls are simply good business practice. At its heart, the auditor's main goal in an ICFR audit is to deliver a definitive judgment, their professional opinion on just how effective a company's internal controls are at keeping their financial reporting shipshape. This isn't just a formality or a box-ticking exercise. It's a critical assessment that directly impacts how investors, lenders, and other stakeholders view the reliability and trustworthiness of a company's financial information.
So this is where the rubber really meets the road.
Yeah.
Why is that opinion so incredibly important? What are the practical stakes if an auditor says a company's internal controls aren't up to snuff?
Because an entity's internal control system cannot be considered effective if even one material weakness exists. A material weakness is a truly big deal. Think of it as a fundamental structural flaw in a company's financial reporting engine. It's a deficiency or a combination of deficiencies in internal control, such that there is a reasonable possibility that a material misstatement of the entity's annual or interim financial statements will not be prevented or detected on a timely basis.
Reasonable possibility of a material misstatement.
Yeah.
That sounds serious.
It is. Imagine a critical, exploitable security flaw in a bank's vault system. Even if no one has successfully robbed the bank yet, the existence of that flaw means there's a reasonable possibility of a material loss. That's essentially what a material weakness represents in financial controls. For you, the listener, understanding this means that an auditor flagging a material weakness is a serious red alert about a company's fundamental financial health, far more significant than just, say, a bad quarter.
So the auditor's mission is to hunt for these material weaknesses, almost like a financial detective looking for crucial cracks in the system that could lead to a massive problem down the line.
Precisely. Exactly. The auditor plans and performs the engagement to obtain reasonable assurance about whether material weaknesses exist as of the specific date management provides their assessment, which typically aligns with the balance sheet date for the financial statement audit. Reasonable assurance is a key auditing concept. It means a high, but not absolute, level of certainty.
Right, not a guarantee.
Not a guarantee. Auditors don't provide an ironclad guarantee that absolutely no weakness exists or that fraud is impossible, but rather that, based on their extensive procedures and evidence, they have a strong belief, a very high degree of confidence that no material weaknesses exist. It's a pragmatic approach to providing a high degree of confidence without claiming infallibility, recognizing the inherent limitations of any audit.
Okay, so that sets the stage. Now let's get into the rules of the game. What do auditors and management actually have to do?
Well, for both issuers and non-issuers, the audit of ICFR isn't a standalone, isolated task. It must be integrated with the financial statement audit. This isn't just a suggestion. It's a foundational requirement that drives the efficiency and comprehensiveness of the overall audit process. You simply can't look at the financial numbers in a vacuum without thoroughly understanding the systems and controls that produce them.
So they're not just doing two separate jobs side by side, like two different teams painting different walls in the same room. They're actually weaving them together, using the same brushstrokes to contribute to one unified masterpiece of assurance. That sounds like a smart way to work.
You've got it, exactly. The auditor plans and performs the integrated audit to achieve the objectives of both engagements simultaneously. This means that when they design their audit procedures, they're strategically thinking about how each test can provide evidence for both their opinion on the financial statements and their opinion on internal controls. This also means using the same control criteria like the COSO framework, which is a common one that management uses for its own evaluation of internal control effectiveness. This alignment is absolutely key for consistency.
So everyone's measuring against the same standard.
Right. If the auditor and management were using different benchmarks, their assessments wouldn't be comparable, which would defeat the very purpose of the integrated approach. Common criteria ensure everyone is on the same page regarding what constitutes an effective control.
And the tests they do. Do they truly serve both purposes, making the whole process more streamlined and less redundant, or is there still a lot of double-checking involved?
Yes, they absolutely do. Tests of controls are specifically designed to provide sufficient, appropriate evidence to support both the opinion on internal control and the control risk assessment needed for the financial statement audit. For instance, when an auditor tests a control related to revenue recognition, perhaps verifying that every sale is properly authorized and recorded, that single test can provide evidence about whether the control is operating effectively for the ICFR audit and also inform the auditor's assessment of how likely a material misstatement is in the revenue balance for the financial statement audit.
Ah, okay, I see the synergy there.
Exactly. This synergy makes the integrated audit incredibly efficient and comprehensive, preventing unnecessary duplication of effort while maximizing the value of each procedure. It's truly working smarter.
Now, for public companies, our sources point back to Section 404 of Sarbanes-Oxley, or SOX. This act, as we mentioned, came into being after some very high-profile corporate scandals to really bolster investor confidence. What does this law specifically demand from management? It sounds like it puts a lot of the onus directly on their shoulders.
It does, and this raises a critical question about accountability in the corporate world. Section 404 requires each issuer's annual report to contain an internal control report. This isn't just a courtesy or a suggested best practice, it's a mandatory public disclosure. This report must clearly state management's responsibility for establishing and maintaining an adequate internal control structure and procedures for financial reporting. This is a crucial point because it explicitly places the primary day-to-day responsibility for robust internal controls squarely with management, not solely with the auditors.
So they're on the hook.
They are. Auditors are there to evaluate and attest, but management is ultimately responsible for designing, implementing, and maintaining these controls consistently.
So management can't just throw their hands up and say it's the auditor's job to find problems.
Yeah.
They have to publicly declare that they own the internal control system and state its effectiveness. That's a significant shift in perspective, moving from merely reporting numbers to being accountable for the very systems behind those numbers.
That's spot on. The report also needs to contain management's assessment, as of the end of the most recent fiscal year, of the effectiveness of that internal control structure and those procedures for financial reporting. This is their public declaration, their assertion to investors and regulators that their internal systems are sound and reliable enough to produce accurate financial information. This assessment isn't just a general, vague statement. It needs to be based on specific, recognized criteria and backed by evidence that management has gathered internally through their own monitoring and review processes. It's about transparency and demonstrating due diligence.
Okay. And you mentioned terminology differences, assessment versus assertion.
Yes, a quick note on terminology for our listeners. Our sources mention that while AICPA standards, which are generally used for private company audits, use the term management's assessment, The PCAOB, which oversees public company audits, uses management's assertion. For consistency and clarity in our discussion today, we're largely sticking with assessment, but it's good for you to be aware of the different terms you might encounter in actual financial reports or audit standards. They convey the same fundamental meaning of management's responsibility and declaration regarding their controls.
Good to know. So what about non-issuers, these private companies we discussed earlier? Do they have similar responsibilities when it comes to internal controls, even without Sarbanes-Oxley Section 404 applying directly to them? It seems like even a private company would want strong controls for their own operational integrity and maybe to attract investors or secure loans, right?
You're right. Strong internal controls are beneficial for any entity. For non-issuers, there are specific conditions. An audit of ICFR for a non-issuer can only be performed if management accepts responsibility for the effectiveness of internal control. This is a non-negotiable prerequisite.
Ah, they have to explicitly accept it.
Yes. If management isn't willing to formally own that responsibility, an auditor cannot provide an opinion on the effectiveness of their internal controls, as the very premise of the audit relies on management's commitment to and stewardship of these controls. They can't just hand it off to the auditors as if it's an external check with no internal accountability.
Makes sense. What else do they need to do?
Beyond simply accepting responsibility, management must also evaluate the effectiveness of their internal control using suitable and available criteria. This isn't just a vague, we think it's good statement. This could be criteria issued by the AICPA or other widely recognized frameworks. There's a recognized standard against which their controls are measured. They also need to support their assessment with sufficient appropriate evidence. This means systematically identifying and documenting control objectives and the specific controls that meet those objectives. Even their own internal monitoring activities, such as regular internal reviews, reconciliations, or performance analyses, can provide supporting evidence for their assessment. It's about a systematic, evidence-based approach.
And they have to put this in writing too, like a formal declaration, even if it's not a public report, quite like what an issuer publishes.
Absolutely. Management must provide a written assessment about the effectiveness of their internal control in a report that accompanies the auditor's report. This formalizes their responsibilities and their conclusions. Crucially, the as-of date in management's assertion, their formal declaration of effectiveness, must coincide with the date of the financial statements.
Why is that date matching so important?
It ensures that the assessment of controls aligns precisely with the financial period being audited, preventing any disconnect between the state of controls and the reported financial position. It ensures a synchronized view of financial health and the underlying systems.
Okay, that sounds like a pretty clear expectation, but what if management just flat out refuses to provide this written assessment? That sounds like it would throw a pretty significant wrench into the whole audit process.
Oh, it definitely would. That's a significant red flag, and auditors take it very seriously because it signals a fundamental lack of cooperation. If management refuses to furnish a written assessment, the auditor should generally withdraw from the engagement.
Withdraw.
Generally, yes. This is because the written assessment is fundamental to establishing management's commitment and a proper scope for the audit. In rare instances where withdrawal isn't permitted by law or regulation, maybe due to specific legal mandates or public interest concerns, the auditor must issue a disclaimer of opinion on ICFR and seriously consider the impact on the financial statement audit. This refusal is treated as a severe scope limitation, meaning the auditor couldn't obtain the necessary information or assurances from management to form an opinion on ICFR, severely hindering their ability to complete the integrated audit.
So it basically stops the ICFR audit cold.
Pretty much. It signals a fundamental breakdown in the auditor-client relationship and management's adherence to professional standards. It's essentially saying, we can't do our job because you won't provide a basic required document.
Okay, so beyond the public report for issuers, or the accompanying report for non-issuers, there's also a direct private letter that management provides specifically to the auditor. This sounds like a private but equally critical line of communication and commitment, almost a formal pact between the two parties.
You're exactly right. For both issuers and non-issuers, the auditor must obtain a written representation letter from management. This is incredibly important because it formalizes management's responsibilities and disclosures directly to the auditor. It's a legally significant document that reaffirms key understandings and commitments, often signed by top executives like the CEO and CFO.
What kind of things are in this letter?
Well, in this letter, management needs to confirm a comprehensive set of responsibilities and disclosures. First, They acknowledge responsibility for establishing and maintaining effective internal control and explicitly state they've performed an assessment of its effectiveness. Second, they state their assessment as of a specified date and specify the criteria they used, reinforcing the framework they followed. Third, and this is critical, they affirm that they did not rely on the auditor's procedures as the basis for their own assessment.
Why is that part so important?
It emphasizes management's independent responsibility. The auditor isn't doing management's job for them, they are evaluating management's own work.
Got it. What else?
Fourth, management must state that they have disclosed all deficiencies in design and operation. This includes confirming that all significant deficiencies and material weaknesses they've identified have been disclosed to the auditor, and they must indicate if any such deficiencies identified in previous engagements remain unresolved. This ensures transparency. Fifth, they must describe any fraud that resulted in material misstatement or involves senior management or other employees with significant roles in ICFR. This is a very sensitive but vital disclosure.
Definitely.
And finally, they say whether there were any significant changes to internal control after the as-of date of the report, including any corrective action taken regarding identified deficiencies. This provides an up-to-date picture.
That's a lot of crucial information packed into one letter, essentially a detailed attestation from management directly to the audit team. What happens if, for some reason, the auditor can't get this representation letter from management? Is it just a minor hiccup or a major problem for the audit?
Oh, that's not a minor hiccup at all. It's a fundamental obstacle. Failure to obtain such written representations is considered a scope limitation. This will generally result in the auditor's withdrawal from the engagement or, at minimum, a disclaimer of opinion on the internal controls. It's a non-negotiable part of the process.
Another potential withdrawal point.
Absolutely, because without this letter, the auditor lacks crucial formal acknowledgments and assurances from management regarding their responsibilities and disclosures. It severely impairs the auditor's ability to form an informed and reliable opinion, as it implies management isn't fully standing behind their own controls or disclosures.
Okay, moving on to planning. So once they've established all these requirements and responsibilities and management has committed to their role, how do auditors even begin to plan such a massive undertaking? What goes into mapping out this deep dive, considering the sheer volume of transactions and controls in a large company? It sounds like they need a truly strategic blueprint before they even look at a single ledger or financial record.
You're absolutely right. It's like a complex puzzle with many interconnected pieces, and effective planning involves developing an overall strategy for the scope and performance of the engagement. Auditors don't just jump in. They methodically assess various factors to tailor their approach and ensure efficiency without compromising quality.
What kind of factors are we talking about?
Well, they need to consider a wide range of elements. First, industry matters. This includes things like financial reporting practices unique to a specific industry. Think about how banks report complex financial instruments versus a manufacturing company with tangible assets. They also consider the general economic conditions impacting that industry, specific laws and regulations that might apply beyond general accounting standards, and even significant technological changes within that industry. For example, a tech company might have very different control risks related to data security than a retailer.
Okay. Industry context is key. What else?
Second, prior knowledge. Any valuable insights gained from other professional engagements with the entity or by reviewing the working papers of a predecessor auditor if the audit firm is new to the client. This builds on institutional memory. Third, entity and business specifics. This involves truly understanding the company's organization, how it's structured, its day-to-day operations, its capital structure, and even its global footprint. These details influence where transactions occur and how controls work.
The company's DNA, basically.
Exactly. Fourth, complexity and change. How complex are the entity's operations? Have there been significant recent changes in the entity, its operations, or its internal control systems? Change is often a major source of risk, as new processes might have untested controls. Think about a big acquisition or a new IT system.
Change equals risk.
Got it. Fifth, management's method. How does management itself evaluate control effectiveness? The auditor needs to understand this, as their own audit will often parallel or build upon management's internal assessment. Sixth, and this is absolutely critical, materiality and risk judgments. The same level of materiality, that threshold at which a misstatement becomes significant, and the same risk assessment process should be used for both the financial statement audit and the audit of ICFR.
Consistency again.
Yes. More attention, logically, should be focused on areas deemed higher risk. If an account or process is historically prone to errors or inherently complex, it gets more focus. Seventh, fraud risk assessment results. The results of the fraud risk assessment performed for the financial statement audit must be integrated into the ICFR audit. The auditor needs to specifically evaluate whether existing controls sufficiently address identified fraud risks.
Makes sense. Controls are the first line of defense against fraud.
Right. Eighth, past communications and public info. Any previously communicated deficiencies, relevant legal or regulatory matters, or even public information, like news articles about investigations, can provide valuable context. Ninth, evidence availability. The nature and extent of available evidence will influence the plan. Robust digital records might lead to different procedures than reliance on paper. Finally, scaling the audit. This is important for efficiency. Smaller or less complex companies achieve control objectives differently than huge corporations. The audit should be scaled appropriately to fit the entity's size and complexity without compromising quality. A small firm won't need the same controls as a Fortune 500, but theirs must still be effective for their context.
So it's tailored to the company.
Precisely. The audit procedures adapt accordingly. Building on that, the auditor's fraud risk assessment, which is already a requirement for the financial statement audit, must be meticulously integrated into the ICFR audit. This isn't an optional add-on. It's a critical lens through which all controls are viewed. Auditors understand that even the most well-designed controls can be circumvented, especially by those in positions of power.
That's a fascinating point. What are some of the biggest red flags or high-risk areas auditors look at for fraud, especially when it comes to management? It sounds like they're looking for where the system might be most vulnerable to deliberate manipulation rather than just accidental error.
That's a key consideration for auditors, where management fraud can manifest. Management fraud and the management override of controls are considered areas of particularly high risk.
Why is override such a big risk?
Because management can bypass or manipulate existing controls, which makes detecting such fraud extremely challenging, it's often more insidious than an error by a lower-level employee. Auditors specifically scrutinize controls over, first, significant unusual transactions. Why? Because they're often the go-to mechanisms for management to hide things, maybe a one-off deal to artificially boost revenue or funnel funds inappropriately, not business as usual.
Things that stick out.
Exactly. Second, period-end journal entries and adjustments. This is a classic high-risk zone because last-minute changes are prime opportunities to manipulate earnings or expenses, like adjusting the score right before the final whistle.
Sneaky adjustments.
Third, related party transactions. These are deals with entities closely tied to the company, like family members or other businesses owned by the same people. They can be opaque and used for personal gain or to inflate results. And fourth, significant management estimates, areas where judgment is heavily involved, like valuations or potential bad debts. Since these are subjective, management can potentially nudge them to present a more favorable picture.
Lots of judgment calls there.
Right. And beyond these specifics, the auditor also needs to consider controls that mitigate incentives and pressures that might lead management to falsify results. Things like aggressive revenue targets, bonus structures tied to reported earnings, or intense market pressure. Auditors assess if the controls are robust enough to withstand such pressures. It's about understanding the human element and the context, not just the procedures.
Given the sheer scale of a large company, do auditors have to do everything themselves, or can they rely on other experts within the company, like internal auditors, who are also tasked with monitoring controls? It seems like a truly massive task for one external team to handle alone.
That's a great question, and it highlights a critical efficiency in auditing. What's fascinating here is that the external auditor may use the work of others. This includes internal auditors, other company personnel, and even certain third parties involved in the company's control environment. But there's a big caveat, and it's a very important one. These individuals must be sufficiently competent and objective in evaluating the effectiveness of internal control.
Competent and objective. What does that mean in practice?
Competence refers to their skills, training, and knowledge, while objectivity relates to their independence and freedom from bias. For example, if the internal audit team reports directly to the CFO and their bonuses are tied to the company's reported profit, their objectivity might be scrutinized more carefully by the external auditor.
So the external auditor has to judge that first.
Yes. The external auditor determines whether and to what extent to use the work of others by considering the risk associated with a particular control. As risk increases, a greater degree of competence and objectivity is required from those whose work is being relied upon. For high-risk areas where the potential for misstatement or fraud is significant, the use of the work of others might be significantly reduced or even eliminated, meaning the external auditor will perform more direct testing.
More risk, less reliance on others.
Exactly. Testing a complex revenue control in a risky industry, likely more direct testing by the external auditor, unless the internal team shows exceptional independence and expertise. It's all about ensuring the audit evidence is reliable and sufficient for their opinion.
Okay, so they've planned, they've assessed risk, maybe decided to use some internal audit work. Now, how do they actually decide which controls to test? Do they just pick randomly, or is there a strategy?
Not random at all. Our sources detail a very structured, efficient method called the top-down approach.
Top-down, how does that work?
It means the auditor starts by evaluating overall risks at the financial statement level, looking at the big picture. Then, they consider controls at the entity level, those overarching controls that permeate the entire organization. And then they focus on specific accounts, disclosures, and assertions where there's a reasonable possibility of material misstatement. It's about efficiency and focusing on the most critical areas first, moving from the broad view down to the granular level.
Like zooming in, starting wide.
Precisely. This systematic approach allows them to avoid getting bogged down in testing minor controls that don't significantly impact the overall financials, focusing resources where they matter most. A crucial part of this top-down approach is identifying and testing entity-level controls. These are broad, pervasive controls that affect the entire organization, rather than being tied to specific individual transactions. Think of them as the foundational principles and overarching safeguards.
What are some concrete examples of these high-level controls? It sounds like they're more about the company's culture and governance than just a specific approval process. What would an auditor actually look for here?
You're absolutely right. They are much more about the structure and culture. They include controls related to, first, the control environment, which is essentially the tone at the top, management's philosophy, the overall ethical values, and integrity.
Tone at the top, we hear that a lot.
It's fundamental. An auditor would observe leadership behavior, review codes of conduct, assess commitment to ethics. If leadership sets a strong example, that's a powerful control itself. Second, management override, which are controls specifically designed to prevent management from bypassing standard procedures. An auditor might look at policies requiring independent review of journal entries or restricted system access. Critical as override is a high fraud risk.
Controls on the control layer.
Exactly. Third, the company's risk assessment process, how the company identifies, analyzes, and responds to its own business risks, including financial reporting risks. A robust internal risk assessment is key. Fourth, centralized processing, how information, especially financial data, is handled. For example, all payroll through a single secure department. Auditors assess controls around that central function. Fifth, monitoring the results of operations, how management reviews performance for unusual trends or variances, maybe monthly budget to actual analysis. Sixth, monitoring other controls, how the company checks if its own controls are working. Internal audits, self-assessments, continuous monitoring systems.
Like checking the checkers.
Right. Seventh, period-end financial reporting. Controls around the closing process itself, accuracy, cutoffs, timely reporting. Auditors look for rigor here. And finally, policies that address significant business control and risk management practices, the formal guidelines for managing significant risks, from cybersecurity to legal compliance.
So if these high-level controls are really strong, did that make the auditor's job easier for other, more specific controls, almost like a ripple effect through the organization? Does it mean they can actually do less detailed testing on the ground level?
That's a truly powerful aspect of the top-down approach. Our sources state that an effective evaluation of entity-level controls can increase or decrease the testing the auditor would otherwise perform on lower-level transactional controls.
No, interesting. So strong top-level controls can reduce lower-level testing.
Potentially, yes. If these top-tier controls, like the tone at the top, robust risk assessment, effective monitoring, are working effectively, it provides a strong foundation of trust. This may allow the auditor to reduce the extent or affect the nature and timing of the testing of lower-level controls. For example, if management's commitment to accuracy is palpable, the auditor might have more confidence in specific transaction controls, requiring less intensive sampling.
Makes the audit more efficient.
Exactly. It's an efficient way to conduct the audit without compromising quality by leveraging effective overarching controls. Next, using that top-down approach, the auditor evaluates inherent risk factors to identify which classes of transactions, account balances, and disclosures are significant, along with their relevant assertions. Assertions are basically the fundamental promises management makes about their financials.
Okay, assertions. That sounds like a very technical auditing term. Can you give us a more vivid picture of what these promises or claims actually mean in practice? And what kind of risk factors are we talking about here? Is it just about the size of an account, or are there more subtle indicators? This raises an important question about what truly makes an account risky from an auditor's perspective.
Absolutely. Think of assertions as the fundamental promises management implicitly makes about every line item. For instance, existence. Do the assets actually exist? Completeness. Have they recorded every single sale? Valuation. Are these numbers fair and accurate estimates? Are complex items valued correctly?
Okay, existence, completeness, valuation.
Right. Also, rights and obligations. Do they own it? Occurrence. Did it actually happen? And presentation and disclosure, is it clearly presented? Now, risk factors beyond just size are more nuanced. They include, first, the account size and composition. A large, complex investment portfolio is riskier than simple cash. Second, its susceptibility to misstatement due to complex calculations, estimates, subjectivity. Think complex derivatives versus simple product sales. Third, the volume of activity, complexity, and homogeneity of transactions. High-volume, diverse, complex transactions mean more potential error points.
More moving parts, more risk.
Precisely. Fourth, the inherent nature of the account. Some, like revenue recognition, are just trickier. Fifth, accounting and reporting complexities. Intricate standards mean more room for error. Sixth, exposure to loss or contingent liabilities. A big lawsuit means high estimation risk. Seventh, related party transactions, which can lack objectivity. And eighth, changes from the prior period. New systems, products, regulations change always introduces risk because processes are evolving.
So lots of factors beyond just the dollar amount.
Definitely. Based on these, the auditor assesses the risk of a material weakness and the risk that could lead to a material misstatement. Higher risk means more audit attention, more evidence needed. Our sources confirm this risk evaluation is the same for both financial statement and ICFR audits, truly integrated.
And how do they get a really hands-on practical feel for where issues might pop up within a company's processes?
Yeah.
It seems like they need to actually see the flow of information, not just read about it.
That's where a walkthrough comes in, and it's one of the most effective ways to identify likely sources of potential misstatement. This involves the auditor literally following a transaction, real or hypothetical, from start to finish.
Like tracing its journey.
Exactly. Imagine tracing an online order. Customer clicks buy, payment processed, inventory deducted, shipping confirmed, sale recorded on reports, hits the general ledger. We're looking for every step, observing who does what documents are generated, what system steps occur. This allows the auditor to truly understand the flow, where controls should operate, and where breakdowns might occur. It's fundamental to understanding the control design.
Seeing it in action.
Precisely. Finally, based on this risk assessment and top-down approach, the auditor selects specific controls to test. They don't test every single control that'd be incredibly inefficient. Instead, they focus on the critical ones, those important in addressing the risk of material misstatement or preventing material weaknesses. This targeted approach ensures resources are allocated effectively.
Okay, so they've planned, used the top-down approach, identified risky areas, and selected controls. Now we get into the nitty-gritty, actually testing those controls. Our sources mention the components of ICFR, which sound like the foundational elements of a strong internal control system. These are probably what auditors are looking for. What are they?
These are indeed the core elements, often called the COSO framework components, widely recognized best practice. Auditors evaluate if they're present, functioning in design, implementation, operation, and working together cohesively. They are. First, the control environment, the overall tone, ethical values, integrity, competence of management, the foundation. If the tone at the top is strong, it helps everything else.
Keep coming back to that tone at the top.
Because it's crucial. Second, risk assessment. How the company identifies, analyzes, manages its own risks relevant to financial reporting. Understanding vulnerabilities. Third, information and communication systems. How relevant financial info is identified, captured, processed, exchanged timely and effectively. Accounting systems, reports, communication channels. Fourth, monitoring. Processes to assess control quality over time. Ongoing evaluations like reconciliations or separate ones like internal audits, ensuring controls stay effective. And fifth, existing control activities. The specific policies and procedures ensuring directives are carried out to mitigate risks. Things like approvals, reconciliations, security, and crucially, segregation of duties.
Segregation of duties, making sure one person doesn't do everything.
Exactly, making sure no single person has too much control over a process. An auditor needs to confirm all 5 pillars are present and interact seamlessly.
So those are the foundational elements. Now, how do auditors actually test if these controls are working in practice? What specific methods do they use? They can't just take management's word for it, right?
Precisely. They need evidence. This is where the rubber meets the road, and auditors use a combination of techniques. In testing controls, they perform several key steps. First, they evaluate design effectiveness. Does the control, if followed perfectly, actually achieve its goal? Or is there a flaw in the blueprint?
So is it designed right in the first place?
Yes.
Yeah.
Walkthroughs are often used here. This combines inquiry, asking staff, observation, watching the process, and inspection of documentation, reviewing manuals, flowcharts. Second, they test and evaluate operating effectiveness. Is the control actually operating as designed in the real world? And are the people doing it qualified and performing consistently? A control might look good on paper but fail if the employee isn't trained or skips steps.
So does it actually work when people do it?
Exactly. Operating effectiveness is typically tested through more hands-on methods. Continued inquiry, thorough inspection of documentation, looking for proof like signatures, logs, observation, watching it happen, recalculation, redoing math, and reperformance, independently redoing the control activity.
Sounds thorough. Is just asking enough?
Absolutely not. A crucial note here, inquiry alone is not sufficient to support a conclusion about operating effectiveness. You can ask someone if they do something, but you need tangible, corroborating evidence they actually do it effectively and consistently. Trust, but verify.
Makes sense. What else is involved in testing?
Third, auditors must obtain sufficient evidence. This means more evidence for higher risk controls. The goal is enough appropriate evidence for an opinion on the overall system effectiveness, not necessarily every single control. It's about the forest, making sure key trees are healthy. Fourth, they address deviations. If controls don't operate exactly as prescribed, they assess the impact. Importantly, a control doesn't have to be perfect. Minor deviations might not invalidate it if the overall objective is still met, perhaps due to other layers of review.
So a few small errors might be okay if the system catches them.
Potentially, yes. They look at the big picture. Fifth, they determine the appropriate timing of tests. This is a judgment call. Tests over a longer period give more evidence. Tests closer to year-end are more relevant, though earlier tests can be supplemented. Finally, they consider knowledge obtained during past audits and incorporate an element of unpredictability. They use past insights, but also mix things up, change timing, controls tested, sample sizes to prevent management from anticipating and gaming the audit, like playing chess.
Keeping them on their toes. That's a great insight. But what if a company outsources crucial processes, like payroll or IT, to another organization? How do auditors handle controls outside the company's direct view?
That raises an important question about controls partly outside the company's direct operation. A service organization, like a payroll processor or cloud provider, might be part of the entity's internal control because they handle transactions or data affecting the financials. In such cases, the auditor needs to. First, obtain an understanding of the relevant controls at that service organization. Know how they process things and what controls they have. Second, obtain evidence that the controls at the service organization are operating effectively. This can be done by obtaining a service auditor's report, often called a SOC1 report.
SOC1 report, what's that?
It's an independent auditor's report on the controls at the service organization itself. Or the auditor could test the client's own controls over monitoring the service provider, or sometimes perform direct tests at the service organization.
So they check the checker's report, or check how the company checks the checker.
Essentially, yes. A timing note is important. If the client's year-end is much later than the SOC1 report period, the auditor needs additional procedures to bridge that gap. And a crucial reporting note. No reference should be made to the service auditor's report in the auditor's own report on internal control. The ultimate responsibility lies with the audited entity and its auditor. The SOC1 is just evidence used.
The main auditor is still on the hook.
Always.
In our increasingly digital world, I imagine many controls are automated, like a system automatically flagging unusual transactions. Does that make the auditor's job easier, since computers are generally more consistent than humans?
That's where the concept of benchmarking automated controls becomes very relevant. You're right. Automated controls are generally less susceptible to human error. Once set up correctly, a program performs consistently. So if the general controls, the foundational IT controls around changes, access, operations are tested and effective, and the automated controls themselves haven't changed year to year, the auditor may not need to repeat specific testing from the previous year.
Ah, so they can rely on prior testing if nothing's changed.
Potentially. However, they would still need to verify that the automated control hasn't changed. This benchmarking strategy is most appropriate in low-risk situations, offering significant efficiency. It means auditors can spend less time retesting stable, reliable automated things and more time on higher-risk areas, human judgment, or new systems. It leverages technology's consistency.
Okay, so auditors test all these controls. What happens when they find something that isn't working perfectly? How do they categorize problems? Are all failures equal, or is there a spectrum?
Definitely a spectrum. The auditor must determine whether identified deficiencies represent significant deficiencies or material weaknesses, individually or combined. This isn't arbitrary. It's based on two key factors. First, the magnitude of the potential misstatement that could result. How big could the financial error be? Second, whether there is a reasonable possibility that the control will fail to prevent or detect and correct a material misstatement. Likelihood plus magnitude.
Okay, magnitude and likelihood. How do significant deficiencies differ from material weaknesses?
A significant deficiency is less severe than a material weakness, but still important enough to merit serious attention by oversight bodies like the Audit Committee. It's a warning light. A material weakness, as we discussed, means there's a reasonable possibility of a material financial statement error going undetected. This is the most serious type, leading to an adverse opinion on controls, very damaging.
Are there any specific red flags that auditors see that almost always point directly to a material weakness, regardless of the company? Something that shouts, fundamental breakdown.
Yes, our sources provide clear indicators situations almost always considered material weaknesses because they show a fundamental breakdown. These include, first, fraud involving senior management. If the top executives are involved, it undermines the entire control environment and ethical tone.
That seems obvious, yeah.
Second, restatement of previously issued financial statements to correct a material error. If they have to redo past reports due to a big error, it clearly shows controls failed. Major embarrassment. Third, identification by the auditor of a material misstatement that the entity's controls would not have detected. If the external auditors find a material error the company missed, it directly shows controls failed their purpose.
The auditors found something the company's system didn't.
Exactly. And fourth, ineffective oversight by those charged with governance, like the board or audit committee. If they aren't doing their job, not asking tough questions, not independence, it allows deficiencies to fester. Importantly, and this is key, a control weakness can be a material weakness even if no misstatement actually occurred. It's about the potential.
The potential for harm is enough.
Right. The absence of a car crack doesn't mean the brakes weren't faulty. Auditors look for systematic integrity, not just the absence of a symptom. The flaw itself is the problem.
That makes perfect sense. So, what if a company has a weakness in one area, but they have a really strong control somewhere else that essentially catches the potential error before it becomes material? Is there a backup plan in controls?
That's precisely where compensating controls come in. If these are tested and found to be operating effectively, they may limit the severity of an identified deficiency and prevent it from being classified as a material weakness. It's like a strong backup system.
Can you give an example?
Sure. If a small team has inadequate segregation of duties, one person can do too much. A strong, independent managerial review of their transactions could act as a compensating control, catching errors before they become final. The auditor needs to meticulously verify this compensating control is truly effective, consistent, and robust enough to justify downgrading the original deficiency's severity. It's about whether the overall objective of preventing material misstatement is still met.
Okay, so after all the planning, testing, evaluating deficiencies, maybe finding compensating controls, we get to the verdict, right? Forming the opinion.
Exactly. After all that, the auditor's ultimate responsibility is to form an opinion about the effectiveness of internal control, the culmination of their work and judgment.
So what does that opinion draw from? Just these specific ICFR audit procedures, or does it incorporate insights from the broader financial statement audit as well? Seems like it should be comprehensive.
You've hit on a core principle of integrated auditing. The auditor bases this opinion on all available evidence from the ICFR audit and evidence from the financial statement audit. This integrated view ensures a holistic, robust opinion.
So they connect the dots.
Absolutely. For example, if the financial statement audit found significant recurring errors in revenue recognition, that strongly informs the opinion on controls over revenue, even if direct control tests didn't initially flag a material weakness. After forming their own professional opinion, the auditor then evaluates management's report on internal control. A critical step, especially for issuers under SOX 404, checking if management fulfilled their public reporting duties.
What are the absolute non-negotiable elements that must be in management's report? What would cause a problem if missing?
Yes, very specific requirements. Management's report should, first, clearly, indicate that management is responsible for internal control. Reiterate ownership. Second, describe the subject matter, for example, controls over financial statement prep. Third, identify the criteria used, like the COSO framework. Fourth, include a statement of management's assessment about effectiveness with the as-of date, year-end, their definitive judgment. And fifth, crucially, describe any material weaknesses identified by management. Transparency is key.
What if management's report is missing something, or isn't quite right, maybe incomplete, misleading, or even deliberately omitting a known material weakness? Does the auditor just note it?
No, the auditor must take strong action. If the auditor determines required disclosures for material weaknesses aren't in management's report, this must be explicitly stated in the auditor's own report. The auditor's report then includes a description of each material weakness not included by management, effectively correcting the omission publicly, a powerful corrective mechanism.
So the auditor calls them out publicly.
Essentially, yes. Furthermore, if management's report is incomplete or improperly presented otherwise, the auditor must modify their own report to discuss the situation and clarify facts. And as we said, if management flat out refuses to supply a report, the auditor generally withdraws.
Okay. What if management's report goes above and beyond, adding extra info not strictly required, maybe explaining things? How does the auditor handle that? Audit the extra info too.
If management includes additional information, the auditor should read it to ensure no material inconsistencies with the main report or their own knowledge. However, the auditor must disclaim an opinion on such additional information.
Disclaim. Why?
Because the auditor scope is strictly defined. Expressing an opinion on info outside that scope extends their responsibility beyond what they've formally audited. They draw a clear line.
Can you give an example of that? Something specific an auditor would disclaim an opinion on?
Absolutely. Our sources provide a great one. If management's report states they believe the cost of correcting a weakness would exceed the benefits, a cost-benefit analysis, the auditor would disclaim an opinion on this cost-benefit statement. Why? Because that's management's business judgment, not an auditable assertion about control effectiveness. The auditor's report would then explicitly state something like, we did not perform auditing procedures on management's cost-benefit statement, and accordingly, we do not express an opinion or provide any assurance on it. Makes it crystal clear the auditor isn't endorsing that judgment.
Draws a very precise line. Okay, last section. We've talked about integration, but especially for non-issuers. What are the distinct differences between an ICFR audit and a standard financial statement audit? Integrated, but not identical, right?
You've hit on a vital point. This raises an important question about specific objectives and scope. While integrated, their primary purposes differ significantly, especially for non-issuers who might choose an ICFR audit. Let's break down the key differences. First, purpose. The ICFR audit expresses an opinion on whether internal control was effective as of a point in time. Assurance on the system itself. The financial statement audit's purpose, under GAAP, is broader. Enable the auditor to plan tests and opine on whether the financials are fairly presented overall. System reliability versus output accuracy.
Point in time versus period of time too, right?
Exactly. Second, relevant period. ICFR audit opinion is as of a specific point in time, usually year-end, a snapshot. Financial statement audit covers a longer period, typically the fiscal year. Third, extent of testing. An auditor's consideration of internal control in a financial statement audit is more limited than in an ICFR audit. For an ICFR opinion, the auditor must test controls over all relevant assertions for significant accounts. In a financial statement audit, they're not required to test controls over all relevant assertions. If they use a substantive approach, more direct balance testing, they might do limited control testing. ICFR audit requires a deeper, broader dive into controls.
So much more control testing for the ICFR opinion itself.
Correct. And fourth, communication of control deficiencies. Timing and nature differ. In a financial statement audit, significant deficiencies and material weaknesses are communicated within 60 days of report release, usually with restricted use language, internal. In an ICFR audit, this communication happens by the report release date, and the report isn't restricted. It's public for issuers or a company's financials for non-issuers choosing it. More immediate and broadly accessible.
Even with those distinct differences, it sounds like findings from one audit can really help inform the other, almost like they're two sides of the same analytical coin, constantly influencing each other. Is there a give and take?
Absolutely. The interrelationships are crucial and are the essence of an integrated audit. Results from one must be considered in performing the other. They feed into each other. For instance, in forming an opinion on internal control, the auditor considers control test results from the financial statement audit. If those tests show a control isn't working, it informs the ICFR audit. Conversely, if the ICFR audit finds a control effective, it might allow the financial statement auditor to reduce substantive testing on related balances, making the audit more efficient.
A real feedback loop.
Definitely. Furthermore, if a deficiency is noted during the ICFR audit, the auditor considers this when determining the nature, timing, and extent of substantive tests for the financial statements. Weak controls might mean more direct balance testing. The auditor also considers if observations during the financial statement audit impact their ICFR opinion. For example, finding actual material misstatements in the financials might imply underlying controls aren't effective, even if control tests didn't initially find a big flaw.
So mistakes found in the numbers point back to potential system issues.
Precisely. There's a crucial insight here. It's important to remember that the absence of misstatements in the financial statements does not automatically imply operating effectiveness of controls, although it may affect risk assessment. Controls can be ineffective even if no error has occurred yet. Maybe management caught it manually, maybe luck intervened. Auditors look for systematic integrity, the robust design and operation, not just absence of a symptom. Build preventative measures, don't just react.
Wow, what a deep dive. We've really unpacked the layers of integrated audits today, from understanding who needs them and why, to the detailed planning and testing involved, and even the critical nuances between different types of audits. It's truly a complex but absolutely essential part of financial transparency and corporate accountability.
We've seen how these meticulous procedures are designed to provide confidence not just in a company's final financial numbers, but in the very systems and processes that generate them. It's fundamentally about building trust from the inside out, ensuring that the financial statements are not just a snapshot, but a reliable reflection of a company's robust underlying operations.
That makes so much sense. Knowing how thorough these auditors have to be and the specific requirements for management to truly own their internal control environment really gives you a new appreciation for the integrity of financial reporting. It's truly a shortcut to being well-informed, wouldn't you say?
Indeed. And this raises an important question for you, our listener. The next time you see a company's financial report, knowing all this, what new questions might you ask about the health of their internal control systems? Would you look differently at an unqualified opinion, or maybe wonder what might be happening under the hood if you hear about a restatement or a new CEO bonus tied directly to reported earnings?
Fantastic thought. Thank you for joining us on this deep dive into integrated audits. We hope you've gained some valuable insights and maybe even a few surprising facts about how corporate trust is built. Until next time, keep learning, keep questioning, and keep digging deeper.